So I wanted to revisit the definition of ordinary share capital because this comes up an awful lot when we're doing management buyouts and other transactions where we might be issuing things like preference shares, and those preference shares make a difference as to whether ordinary shareholders will obtain things like business asset disposal relief when they come to sell their shares in the future. It's quite often that if you've got preference shares, they're going to swamp out any ordinary shares if those preference shares need to be included for the purposes of defining what ordinary share capital is. So ordinary share capital is defined in section 989 of the Income Tax Act, which basically says it's all share capital however described, except capital that gives the holder a right to a fixed dividend and no other right to income. I wrote in Taxation magazine about a year ago about preference shares, and one of the things I mentioned in there was about the HMRC manual and certain examples it gives, and I'll put a reference to that HMRC manual in the links. But the point is, there was a update to HMRC's manual not long after I published that article, where HMRC changed a couple of their definitions. One seems to be off the back of the case, the tribunal case of Warshaw, and in that case they examined for Mr. Warshaw actually wanted the preference shares to be ordinary share capital because it would mean that he would qualify for entrepreneurs relief as it was at the time. So a couple of interesting comments from the judge on the Warshaw case. The first is that he basically said that just because something is debt-like doesn't necessarily mean it shouldn't be treated as ordinary share capital, so that's something to watch out for. The other thing with Warshaw is that his shares gave him a right to a 10% cumulative preferential dividend. On the face of it, you might think if it's 10%, it's a fixed rate. Actually, the 10% included within the calculation of the 10% was any previously unpaid dividends. So the meaning of that was the upper tribunal said for it to be a fixed rate, it can only have two variables. It had more than two variables because now not only do we include the face value of the preference shares, but we need to add to that any unpaid dividends. And therefore, when you actually look at the calculation, it's not necessarily 10% of the face value. It's become a variable dividend, and therefore those preference shares were treated as ordinary share capital. So it's those little quirks that make a massive difference in cases like Warshaw as to whether they are ordinary share capital, whether we get things like business asset disposal relief. And Mr. Warshaw was able to successfully claim entrepreneurs relief, and both the FTT and the upper tribunal sided with Mr. Warshaw in that case. But that's a really important point as to whether we need to consider something as being ordinary share capital when we're doing things like planning on MBO transactions, and obviously not forgetting things like McQuillan and Castledean in looking at things that have no rights to dividends whatsoever.